I'm going to go over the top dividend stocks I own and am currently investing in. While I am not strictly a dividend investor, I believe these stocks will be able to continue to pay their dividends, raise them in the future, and even provide long-term capital appreciation, with their stock prices increasing potentially 2 to 3 times over the next 5 years. I will go over some of the key financial metrics I like to look at, cover the risk factors, including major headwinds the companies are experiencing. When a stock is trading at a discount, there is always a reason, and you're never going to get a great stock without any problems at a great price. This is why understanding the current headwinds is so important, and trying to understand if these headwinds are a fundamental deterioration of the company or something more short term the company is likely to overcome. And remember, this is not financial advice of me telling you to go and buy all these stocks. I'm just sharing my top dividend stocks I personally own. You don't know what price I bought these at, how much they make up my portfolio, and when I plan to sell them, or what changes might cause me to change my analysis. Now let's get started. First up is Best Buy, with around a 4% dividend yield. Its current forward PE is around 13, and its return on invested capital over weighted average cost of capital is 24% over 10%. This is a very important metric I like to look at because this shows when the company reinvests its money if it's able to provide you a good return. Typically, when your return on invested capital is lower than your weighted average cost of capital, you may be destroying value in the company. But with Best Buy, this is very the opposite. When they reinvest their money into the company through investing in their own operations or even acquisitions, they typically return very high returns. Next up is their very high dividend growth rate. Over the last 5 years, they've been growing their dividend by 19.1%. And this is also only with a 0.33% payout ratio. Another big factor I like to look at is their operating income and their interest expense. Last year, or in the last current year, Best Buy's operating income was about 2.7 billion and their interest expense was only 25 million. This means Best Buy almost has no debt that they have to pay interest on. This leaves Best Buy a lot of opportunities and be able to weather a lot of storms such as rising interest rates. They also have the opportunity, if they do want to do big acquisitions or do need to take on debt, they can take on debt because they currently don't have any. And they're also buying back shares at a very nice pace. The last 3 years, they've averaged buying back their shares at 5.1% per year. The main problem with Best Buy right now, as you can see in the top right chart, is their revenue and EPS is expected to decline in the next several years. This seems to be largely due to the current economic headwinds. And while this is a factor in the short term, I do not believe this will last forever. And with Best Buy's good financial metrics of low debt and really high return on invested capital, when the macro conditions do improve, Best Buy is likely to improve a lot as well. You can also see the chart at the bottom of Best Buy's long-term stock price history from the mid-1980s to the current date. And even from a technical standpoint, it does look like an attractive point to buy, and Best Buy is in a long-term uptrend. Second up is Clorox with a 3.2% dividend yield. A lot of its metrics don't look very good, but that's because of the current problems it's having. As you can see, its forward PE is still very high at 35, and its return on invested capital over weighted cost of capital is 10.5 over 2.3. While this is actually an attractive number, in the past, Clorox's return on invested capital has been around 20%. And this is largely because of the earnings dip, as you can see in the right-hand chart there. After the current boom they had in the last few years, the earnings have significantly contracted. But the good thing is their dividend growth rate has been at 8% average over the last 5 years. And again, their payout ratio is currently high at 1.34 because of this short-term contraction in earnings. And this is in the last year, their operating income is only 719 million, where compared to last year, it was 1.2 billion. But this is still very manageable because their interest expense is only 106 million. So even with this large contraction operating income in the short term, they're still very easily able to service their interest expense. They've also still been buying back shares with an average of a 0.7 buyback ratio over the last 3 years. But the main thing with Clorox is their gross margins have contracted. They used to average around 44%, and now this has contracted to 36%, which I feel is mainly due to the inflation and supply chain issues. Well, this issue won't resolve overnight. It should slowly resolve over the years. And as you can see in the chart I have in the top right-hand corner, analysts are expecting this issue to resolve itself. With revenue, while it's staying flat, the EPS is increasing, meaning the gross margins are going to be creeping back up. Also, another nice thing is Clorox has had no dividend reduction since 1978. So this is one of those dividend kings that has always paid back their dividends. And from a technical perspective, you can see the long-term history of the chart, again from the mid-1980s to the current date, is a very, very strong uptrend. And Clorox is currently at a very nice pullback. If you compare it to the past periods, the 2008-2009 crash and the 2000 crash, Clorox is about equivalent pullback as then as it is now. And this is one of the reasons I also think it's a very good buy. Third up is 3M, and it's very fitting that number 3 should be 3M. With almost a 4.1% dividend yield, it currently has a forward PE of 14 and a nice return on invested capital over weighted average cost of capital of 16.86 over 6.09. And it's also been very good at growing its dividends over the years, with the average 5-year dividend growth rate of 6.4% a year, with a 0.83 payout ratio. This payout ratio is a little high because, again, their operating income is lower this year than last year. Their operating income in the last year is only 5.36 billion compared to last year, which is 7.6 billion. But overall, 3M has a very good debt profile, as their interest expense is only 476 million. So this is very easy for them to service, even with this contraction in their operating income. And also, they've still been buying back shares with an average of a 0.3% buyback per year. Now, as you can see, the current analyst estimates going forward, they're expecting the revenue to grow and the EPS to grow. 3M has also had no dividend reduction since 1959, but there's a lot of current issues going on with the company. The main one being lawsuits over faulty earplugs. This is from a division that 3M acquired, I think, around 2009. But these faulty earplugs, to my understanding, were sold by this division they acquired well before 3M acquired them. They've currently already lost several lawsuits, which have cost them a few hundred million or a few tens of million. And a lot of the estimates were expecting this could cost 3M billions and billions and billions. But they currently are trying to declare bankruptcy on that one division, which they are expecting to have a $300 million cost. And they've also put aside $1 billion for the lawsuits. Obviously, the lawsuits, they're seeking more and more money, billions and billions of dollars by 3M. But I think 3M will be insulated from this and will only affect that one division. Another thing that's happening is 3M is spinning off their healthcare unit. Well, this is about 25% of the business. This may actually be good for 3M in the long term, as it's not going to get bogged down too much in the future, and you are still keeping the majority of the core 3M business there, which, if they continue operating like in the past, it should be a very good deal. And finally, you can see again the long-term stock trend chart for the mid-1980s to the current date is being a very consistent long-term uptrend. And 3M is going through a very large pullback because of these issues. But this is probably why the dividend yield is so high and the stock price is so attractive right now. So if you feel that 3M is going to get through these issues of the lawsuits and the spinoff is going to go well, 3M may be a great buy right now. Fourth is Walgreens, with around a 5% dividend yield and a very low forward PE of 8. Although next, under the return under invested capital over weighted average cost of capital, you see the real problem in the company, being only 3% over 2.95%. This means that Walgreens is getting a very low return on their invested capital, so it's going to be very hard for them to grow in the future. This number could improve or it could deteriorate, but I wouldn't expect large returns or growth from Walgreens in the future, although this is made up for from their overall good fundamentals of the core business still. They still have a nice attractive dividend yield with a good growth rate of 5.7% average per year over the last 5 years and a low payout ratio of only 0.32. Their operating income is 2.7 billion with interest expenses of only 382 million, so they're very easily able to service their interest expense. They also have been buying back shares, an average of 3.1% per year over the last 3 years. As you can see from the analyst estimates in the chart in the top right-hand corner, the revenue is expected to keep increasing, and the general EPS trend is up. Well, the last year, there was a spike because of a one-time income. The overall trend you can see is going up, and it looks like the estimates of that core fundamental business is expected to stay. You can also see from the chart from the 1980s, it has been in a strong uptrend until recently, where it has really deteriorated. And it's almost sideways trending with a very maybe slight upwards hint to it. And this is what we're seeing in the financials too, and from the financial metrics such as the return on invested capital over weighted average cost of capital, telling us that Walgreens is having trouble growing anymore. And this is interesting because this is also being reflected in the chart. But as you can see, where it is from a technical perspective, it does still look like a good time to buy, and Walgreens' dividend yield is currently at a record high. Fifth up is British American Tobacco with a huge dividend yield of 7.2% and a low forward PE of 9.6. Although you see the first problem, which I think is temporary, of that the return on invested capital over weighted average cost of capital is 4.66 over 6.02. Traditionally, if this keeps up, it means when they invest their capital, they would be destroying value. But British American Tobacco has had little periods where this metric was bad in the past, such as between 2009 and 2011, and they were able to improve it, which I think will happen again. Their dividend growth rate has also been very nice at an average growth per year for over the last 5 years of 4.5%. Next, for the payout ratio, I am basing this on free cash flow rather than their net income, because right now they have a lot of non-cash write-downs affecting their net income. So this adjusted payout ratio is only 0.49, as their net income is actually only showing as $7 billion, but their free cash flow is $12 billion. Their operating income is $11 billion with an interest expense of $2 billion. As you can see, compared to a lot of the other companies, this is a very high interest expense. And this is from an acquisition that British Tobacco did in 2017. And this is the largest headwind I feel that is existing with the company. They did this large acquisition and they took on a lot of debt. And since then, there's been a lot of depreciation and there's been a lot of impairment costs since the acquisition. This is why their net income is so much lower than their free cash flow, because they're having to write down all these bad assets on their balance sheet as time goes along. But since this has been already been happening for several years, and there's also been a lot of integration costs with these businesses together, I feel they're maybe entering the tail end of this and they'll be able to start progressing forward in the future. And because their free cash flow is so high, they can put significant amount of money to pay down the debt. And as they pay down the debt, I believe the market will respond positively to this. As you can see in the top right chart, British Tobacco has actually been a very consistent revenue and earnings grower. These have been very stable growth stocks over the long term that do yield high dividends. But they do have these current problems in the short term. And also, as you can see from a technical perspective, since the mid-1980s, the current date, the stock has been in a long-term uptrend. And as you can see, after this acquisition happened, the stock price got punished severely. Most likely, like I said, because they've overpaid and they've been having to do a lot of write-downs. But this stuff has already happened now, and you have to look at what's going to be happening in the future for the stock. And this is the reason why I like British American Tobacco at this price today. And my final dividend stock is Altria Group, with a large dividend yield of 7.9% and a low forward PE of 9.41. They also have a very good return on invested capital over weighted average cost of capital of 17.44 over 5.49. They've also been growing their dividend rate at a very nice clip as well, at 8.9% per year average over the last 5 years. Again, just like British Tobacco, I've based their payout ratio on their free cash flow, and their payout ratio is 0.8. And again, it's a lot of the same problems as British American Tobacco had, is they have good operating income of around 11 million, but they do have a high interest expense. Altria Group has also been using some of this cash to buy back shares with an average of a 0.9 buyback ratio over the last 3 years. But again, they also did an acquisition in 2018, which left them with a lot of debt, and there's been ongoing restructuring costs. There's been more depreciation and impairment costs, causing their net income to be a lot lower than their free cash flow. And the stock price has been punished for this. But as you can see from the analyst estimates in the top right chart, their revenue is expected to be steady to increasing, and their EPS is also expected to be increasing. And from a technical perspective, you can see from the mid-1980s, the current date, the tobacco company has been in a nice long-term uptrend as well, and is currently at a nice dip, which looks like a favorable buy for the long term. And also just to cover the whole tobacco industry, if for covering Altria Group and British American Tobacco, the companies just don't sell cigarettes. They also sell the vape pods and other transitions to get people off of smoking. They're also getting into the cannabis industry as well. So while in a lot of the Western countries, smoking is looking more and more frowned upon, these companies are transitioning into what is kind of the future. And they have had a very long history of providing very good return to shareholder over the years. Also, in a lot of other countries around the world, smoking is still a thing. So this is therefore a global market, not just the American market. I hope you enjoyed the video, and remember to like, share, and subscribe. It'll really help my channel, and I plan to keep producing great content like this. And feel free to leave a comment. Give me your thoughts on what you think of these dividend stocks, or any other dividend stocks, or any stocks in general you would like me to cover in the future.